2025 has been a great market year. We had great economic data. We had inflation in check, lower than expected year-to-date numbers through November, although November was a little high, 4-ish. We had GDP very strong, 4.3 in November, and year-to-date over 2%, where we thought we would be at the 1.5 range. And we had strong market returns with the S&P about 16%. When we look at bonds, positive as well, 7%. We haven't seen that in quite a long time. The Fed did its job. They cut interest rates as they said they would. The amount of times that Chairman Powell suggested the committee would do each period. And the trajectory, as far as Larry Adams, our economist, chief investment officer, says is that next year, 2026, we should expect continuing rate cuts. And we will have a new Fed chair appointed second quarter. The president does that. Someone will take the job of Powell and he will retire. What we really saw in the past 3 years is a narrow market. And what I mean by that is 3 years ago, it was less than 50 stocks in the S&P, mostly growth and tech and AI, that attributed or accounted for almost 90% of the return. 2 years ago, same story, about 140 stocks, only 10 international and less than 10 in value. 2025, we saw broadening out even more. And the last quarter of this year, we saw large value stocks for the first time really pick up. And this last month of the year, the Dow had an incredible comeback. So we would say that tech, growth, and AI kind of ruled the roost again this year. But value stocks are compellingly cheap. And we've been talking about this for 3 years. The great Warren Buffett has stepped down from running Berkshire Hathaway. He's still on the board as a chairman or chairman emeritus. His protege, Greg, of 31 years, has taken over. And many people thought that might have the value market stumble. It did not. It did not. He's still with us and still going to go to work every day. But be that as it may, value stocks from a numbers perspective, price divided by earnings, the lower the PE ratio is, the better buy that stock is, are starting to look interesting. And we would say that rational thought is coming back. The enthusiasm for AI isn't going away, and convergence is still happening, meaning AI is getting more and more into every industry. But people are saying, hey, maybe I should look at some of these great, long-standing companies that are blue chip in nature, pay a dividend, and they're inexpensive compared to the earnings they make. So we think that will continue into 2026. International also did well in 2025. We had developed economies, meaning headquartered in Europe or Japan, do good after 2 years prior, doing pretty good as well. Emerging markets, great returns. And we think that that will continue, especially as the tariff issue is resolved. We also think that the tilt towards global, meaning don't care where you're headquartered, just give me the biggest, best companies of the world, is a little bit safer, easier way to play some of the mainstream leaders in the space, and that's worked out very well for the past 3 years. Small and middle-sized companies, sometimes called SMID, that's 2026 year. And perhaps, or typically, large companies tend to come back first, post-COVID, because they were safer. Growth historically comes back before value. Then international, large cap, and then small and middle-sized companies. So because there's so much, not to be corny, value in value, small and middle-sized companies have lagged. So we've been pretty nimble in our asset allocation or percentage that we recommend, and it based really on your risk tolerance, how old you are. That really defines the mix of investments that you have. But generally speaking, as we grow older and get to retirement age, we want income. We want to get that check in our account or money in our account every month so that we can replace the lost wages we no longer have. So we tend to shift more towards bonds and maybe some income producing stocks, which typically are value. Larry, again, our Chief Investment Officer, he really likes infrastructure for 2026, healthcare because it was beaten up so badly the past couple years, and financials because as interest rates go down, the cost of borrowing is less or purchasing a house for your mortgage rate, and that tends to spur people to take an action and maybe not hold back as much and buy. When rates are high, people tend to tighten their belt a little bit more. So we think we are not going to have a recession in 2026. Larry believes, and he's couching because, we just wrapped up 25, that we're going to have a volatile, not just straight up like an arrow market, but a positive market. And remember, as far as bonds, as interest rates go down, down, and down, you really want to look at the money you have in cash and money market, cash alternatives, and say, what am I getting in interest? And maybe shift some of that money to short-term bonds that would lock in the interest rate you're getting for the period or time, maturity date of the bond, instead of having all of that money in cash. So that's where a cash flow model or retirement planner comes in, where we can see what is it that you spend every year, what do you earn or collect in Social Security or pensions, what do you spend, what do you make, and how much do we need from the portfolio. And if it's something that we can fix, mean greater income, by moving you from cash to shorter term bonds that lock in a higher rate to meet the income demand, or maybe look at some of those value stocks that pay a dividend to meet the income demand. We want to know how we rebalance you to meet all your goals. And it's not just looking at today. So what we want to do is go year by year by year. And if you have an event where something's changed and it's costing you more or less money, if you won the lottery or you have a huge raise and don't need income as much from your portfolio, sometimes that cash flow model allows us to make a decision better because we can see not only this year, but year by year, how does it affect my growth? And what do I need, the ultimate goal, to do to change little tiny changes every year so that I can live like my highest earning income years until not just 100 anymore because of AI, we might be half robotic if we can make it when convergence happens But let's say out to 105 or 110, like our highest earning income years. And if we meet goal, then we sometimes say, well, maybe I can take that vacation here or there. But that's how it kind of all ties in to the forecast, what our investments are, how we may want to shift or change them, and what does it do to our retirement plans and beyond and our cash flow. I want to wish everybody a happy new year. I hope you had great holidays. I know these are kind of tumultuous times and a lot of things are going on in the economy and politically and conflicts and tariffs. But I hope everyone had a great 2025 and honored and celebrated with their family and friends. And I wish everyone the best 2026.